Hey there, it's Hutch with BankingTruths.com. Today we're going to talk about 4D banking, or the four dimensions of infinite banking. And this is a comprehensive approach beyond just life insurance to maximizing compound interest using strategic and defensible leverage. Now, this is by incorporating assets you probably already have, like retirement plans, stocks, real estate, even if it's a personal residence, and precious metals possibly. So billionaires, they take a buy, borrow, or die approach, as we can see in this article. People get upset because the wealth gap keeps widening and that these billionaires are paying very little in taxes. That's because they use this approach. They keep their assets compounding, and when they need money, they borrow against them tax-free, and that allows them to pass on this massive legacy. So you probably remember from watching my early basics of infinite banking video that single-use assets, or being on the saving, spending cycle, robs you of compounding. You just never get that lift with the green arrow like you do if you keep your assets compounding over time. But if you have to spend them to do things, you never get to the best part of the compound curve. And linear 2D banking with insurance solves this, at least for whatever liquidity you put inside these insurance policies. However, all of it pales in comparison to using all four dimensions. If you think it's beyond just linear, you're using multiple assets, and the fourth dimension is time, keeping them compounding and coordinated over time to get the best attributes of each. So what are these four dimensions? Of course, there's life insurance, and you can see there's two policy types. Traditionally, it's thought of that only whole life can work for infinite banking, and we agree that this should be your foundation. However, index universal life can work, assuming it is chosen, designed, funded, and monitored properly. It can provide some unique benefits that whole life can, and we're going to talk about that within this course. Also, stocks and ETFs, these are exchange traded funds, mutual funds that trade like a stock in a brokerage account, can work. So this is not a recommendation to just go out and buy a bunch of stocks, but a lot of you already have these, but it's like a quasi-retirement fund. It's just this thing that sits over there, has no utility for your financial now. It's something for your financial future, and we're going to show you how to unlock the equity and actually get some very unique loan benefits and tax benefits by incorporating stocks in a brokerage account into a comprehensive 4D banking approach. Also, self-directed retirement accounts. Ooh, most infinite bankers say you can't put any money in IRAs or 401ks. Oh my gosh, they're going to tax everything 100%. And we agree there are dangers there, but again, a lot of you have these accounts, and by tweaking how your IRA 401k is, you can actually unlock some equity, or at least reposition things so that it is optimized within a comprehensive 4D banking system. And last are hard assets. So real estate and precious metals. These are the least liquid. Some people think they're not liquid at all, but they actually can be, and these provide a good backstop for these other options that are more liquid. To be clear, the options on the top, the life insurance policies, two different types, and the brokerage account are really your workhorse, and the bottom are the backstops. So let's look at the impact of a comprehensive 4D banking system versus the old school linear 2D banking system. We know that you want to use life insurance and liquidity to invest in real estate or your own business, or just keep it compounding for you even when you have to use it for other things. But just imagine how your capacity increases by using a comprehensive 4D banking system. How much equity is opened up, not to mention you get to unlock other advantages that aren't necessarily in just whole life insurance. And this brings us to the four dimensions, the 4Ds within each asset class. So when we look at any asset class, we have to consider their tax exposure, their growth potential, their ongoing risk and volatility. Obviously, whole life doesn't have any, but when I talk about some of these other things like stocks, retirement plans, you get concerned because there is risk and ongoing volatility. But if you're using and strategically coordinating them, you can mitigate a lot, if not all of that risk. And last, what I call the triple L's: liquidity, leverage, and loan rate. So liquidity is how much liquidity is available, a lot more if you're using lots of asset classes. Leverage is LTV, or loan to value ratio. Life insurance gives you the most at 95 loan to value because it's the safest. But using that to pair it with these other asset classes, you may open up additional sources of loan to value, and of course the loan rate. So we've seen that the floating loan rate of whole life isn't getting out of control, but it definitely went up. And there's opportunities to lock in your loan rate or take a more tax efficient loan rate using these other asset classes. So let's look at the problem with what I call the typical 2D, two-dimensional liquidity profile. Is people usually have these two assets and they're like polar opposites. So some kind of high yield savings account, or maybe not even high yield, and some kind of retirement plan, whether it be a 401k, 403b, IRA, simple, doesn't matter. The growth potential looks something like this. Like it's terrible in the savings account. The retirement plan is green, but notice it's a light green. That's because you have a silent partner in that deal. We're going to talk about taxes in just a little bit, but the loss potential, it's great in the high yield savings account, other than the fact that there's this silent tax of inflation. You're not getting enough yield to keep up with inflation. And with the retirement plan, there's ultimate losses possible depending on what you invest in. There's the current taxation, which in the savings account is horrible. It's red. You get taxed every year with whatever kind of crumbs they give you, the bank gives you. The government wants their cut of that action. And with the 401k, 403b, it feels great. You're not getting taxed on the way in. You're not getting taxed on the growth. But the future taxation of it is horrible too. Eventually, when you go to use it, once you want the utility of the asset, you're going to pay the piper. And obviously the high yield savings, you're just getting taxed every year. Some of you have Roth IRAs, Roth 401ks, mega backdoors, 529 plans, and there's a lot of green there. There's a lot to like. There's still the loss potential, but obviously the growth potential is great. The taxation is great once you get it in there after tax, and there's no future tax. That's awesome. But again, the utility is you can't use it before you're 59 and a half unless you just pull out your principal. You can take your principal at any time, but you lose any arbitrage potential for all these assets. Like it's a single use asset, right? It's a saving, spending cycle. Everything's single use. And so efficiencies are lost in this type of system. So let's look at how just incorporating plain old vanilla whole life with traditional infinite banking increases efficiency. You can see there's a lot of green there, but we also unlock some additional columns that have to do with the arbitrage potential. Now all of a sudden your liquidity still rides the compound curve even while you're using it for other things. If we incorporate index universal life, you see even more green. Now again, this assumes that it's chosen, designed, funded, and monitored properly. There's a lot of junk being sold out there, but when it's designed properly for banking, you pick up a lot of green and efficiency. Even better, we don't need a high yield savings account if you have some combination of this insurance going. You just need like a basic conduit checking account. And if we add a brokerage account, you can see even more green. Yes, there's red, but that's why you have the insurance to go ahead and protect it. What I want you to notice is if we look across every single row, growth potential, you see bright green. Loss potential, you see bright green. Current taxation, you see green. Future taxation, green. Arb potential, bright green. Locked loan, bright green. Available LTV or loan to value, bright green. And so by incorporating all three of these assets together, we get the best of all worlds with 4D banking. And you get to choose how to transfer the loans or leverage between the different assets to utilize their best features. And when there's risk or where there's exposure, you have the other ones to backstop it. Furthermore, if we look at all the asset classes, if you remember, the top is your workhorse. So instead of just using life insurance to invest in real estate or your own business, you now have this other asset class, and you have these other asset classes that were, again, single use or dead assets from a liquidity standpoint that are backstopping everything. So if you want to learn how to take infinite banking to the next level, maximize your compound interest, minimize the loan drag, maximize your optionality, go ahead and go to 4dbanking.com. You can see I did an hour-long webinar on the whole subject. Put your information there. It's free, and I think you're going to like what you see.